Time for the latest earnings outlook now with Research Director Shiraz Mian. Shiraz, we're coming up to the start of the Q1 earnings season that starts on Monday, the 8th of April.
That's right.
When Alcoa reports. So far, we have not gotten much negative corporate guidance ahead of the beginning of the season. So does that mean that we're going to be looking for some actual earnings growth here in Q1?
No and no. To the first thing, yes, the negative pre-announcements have been fewer, but a big reason for that is that most of these guys took the big bath when they reported the Q4 earnings.
I see.
So they had set expectations at the time low enough that they are comfortable with where the street is, but no, there's no growth. The overall aggregate consensus expectation for Q1, based on our estimates, is for negative 2.6% earnings growth from the same period last year. The actual story is actually not that bad as this growth rate will tell you. A main reason for the negative growth rate is that Q1 2012, the comparative period for this quarter, was the strongest quarter that we have had since this earnings cycle got underway in 2009. So weak guidance and very tough comparisons give you this negative growth outlook for Q1.
What about margins? What are you looking for there?
Yes, it's a mixed bag. Overall weak. So this 2.6% growth rate primarily comes from a comparable decline in revenue and then a modest decline on the margin side. As I've been saying repeatedly here, margins have effectively peaked already in 2012. We are close to levels where we were at the peak of the last cycle in 2006, 2007. But expectations are for continued momentum on that front.
Yeah. So standout sectors here in Q1?
You know, on the weak side, finance stands out. They're expected to have negative earnings growth after many quarters of double-digit earnings growth. And in there, it's the same story. It's just very tough comparisons. In fact, for Bank of America and AIG, the comparisons are extremely tough. They had very, very strong first quarter of 2012. If you exclude those two companies from the finance sector, the sector's picture doesn't look that bad. Tech, the biggest sector in the S&P 500, is also weak, expected to be down about 5-6%. And that's quite broad-based. It's not just Apple or Intel, which had very strong Q1 12. So the tech weakness is quite broad-based. On the positive side, home builders, construction is doing good, as it has been consistently doing over the last many quarters. Utilities should do relatively better this quarter versus we saw them perform in Q4. So kind of a mixed bag. Overall, about half of the Zacks 16 sectors will have negative earnings growth. Another 2 or 3 sectors will be barely in the positive category. So not a very inspiring picture overall. But the story is of tough comparisons, weak guidance.
All right. So the street's still expecting strong second half growth.
That's right.
Earnings.
That's right.
Are you expecting? Because you've been skeptical of that.
I have been. That's right. And the primary reason why the market is not spooked by these negative growth numbers is because the market is looking ahead to a period of plenty. They think that the second half of 2013 will bring us close to 10% year-over-year growth. And then they expect that growth momentum to continue into 2014, giving us close to 11-12% growth again there. I have been very skeptical of that.
Yeah, and why? Why are you so skeptical?
Because growth can come only from two areas. It's either the top line, which is revenues or sales, or it's margins. Now, if you could have strong revenue growth and margins stay stable, you could get to those kind of growth expectations. But to get strong revenue growth, you need strong GDP growth. The nominal GDP and revenue growth for the S&P 500 move literally in lockstep when you regress one over the other. So you can't have revenue growth without GDP growth. And as we saw this morning with the very weak non-farm job numbers, continued recession in Europe, problems and issues in the rest of the emerging markets outside of China, expecting global GDP growth is way too optimistic. And just briefly on the margins front, by the middle of this year, we will be at the same peak where we were in 2006. The Street expects margins to go beyond that, expand beyond the prior peak into the end of 2013 and grow even further in 2014. Now, pigs fly too, they say. And there are fairies somewhere out there too.
There's one on a television commercial that plays on his iPad or something, a pig.
I would love to believe that
flying in an airplane.
That's right. So I would love to believe that margins can expand as the Street is expecting, but it hasn't happened in the past. So let's see what happens.
All right, yeah, we'll check in with you throughout the earnings season. In the meantime, if you want to check Shiraz's updated thoughts on this upcoming earnings season, a couple of places you can do that on our website, Zacks.com, if you're not there already watching this video. He has his earnings trends written report that he updates probably weekly throughout the peak earnings season. And then he has daily comments on the nuanced changes in the season that you can find in Ahead of Wall Street, which he writes as well. With Shiraz, I'm Terry Ruffalo.